Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do every Wednesday. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar. We'll look at oil, gold, and silver, and then we'll move on to any chart requests if anyone has any. Those of you that are in here, if you have a chart request, feel free to add it into the chat. Those of you that are going to watch this video somewhere else later, you can always message me on Twitter at StockDarts. You can find the copies of these videos at YouTube, or you can visit and find more of my content at patreon.com/StockDarts, where I post weekly blog content, usually giving you ideas of how I'm going to go ahead and approach the week and trade. And, just basically give you a better idea of how we go ahead and approach and take advantage of the information we come across during these Wednesday webinars. We're going to spend most of this webinar, again, in the beginning portion, just analyzing the markets and trying to figure out what kind of environment we're in. And like I said, if you have a question and we can't get to it here, just you can always message me on Twitter, and I'll be more than happy to help you out. All right, so let's take a look at the S&P 500 first. We'll take a look at STNG when we can, Fat Boy. All right, so interesting week. We had a pretty big start, a pretty big explosion upwards in the markets. We are starting to see a little bit of selling pressure. We're seeing, again, a little bit of sector rotation, but overall the markets are still looking pretty strong. We're seeing definitely a kind of reversal back to what the market was doing earlier this month, and actually for the most part of the last couple of months, which is strong tech names, and some of these areas that were really ramping up over the last few days have started to slow down a little bit. You can see, again, we look at just up here at the top right, you can see the NASDAQ is up almost 1%. You got IWM down almost 2%, and the others, S&P 500 and Dow Jones, a little bit red. Right, so we're seeing money kind of start to rotate back out of those areas. The Dow Jones and IWM in particular were really ramping up and playing a lot of catch up over the last 4 or 5 days, and we're seeing some profit taking there and maybe money rotating back into the Qs and into some of these stronger tech names. Overall, I think the market is still doing pretty good. I think that we have hit a level that I'm expecting strong resistance, and I think that we are reaching close to a point that I would expect a reversal and a pullback in the market. Now, we haven't really seen that yet, but that's really my expectation at this point. I've been waiting for the NASDAQ to hit new all-time highs. I consider that to be an important goal of this particular market, and now that we've hit it, we've reached a point where there's really not much more left to go other than to new all-time highs, and to have these other indices follow suit. And I don't know that we're really ready for that yet, but, again, what our opinions are don't really matter. What matters is what the stock market does. And at this point, I'm starting to sprinkle in a couple short trades in some weaker areas, but I'm still waiting for a broader market reversal before I go ahead and get too aggressive to the short side. Long trade ideas are still working. Those of you that are regular viewers or readers of my Patreon page, you'll know that one of our long trades is working really well today. A couple of our short trades are also working this week, and I think overall, we're in an interesting market where the market, if you just look at the indices, it looks like we're just going to new highs. But underneath the surface, there's a lot of different areas of the market that are doing different things. There's been money rotating back and forth through strong areas and weak areas, and we're definitely in a market right now where the stock that you pick and the stock that you trade makes a big difference in how you're going to basically do during these times. If you trade back in March, February, or even January, the market, for the most part, pretty much every stock was following the market overall. So if you were long in January or February, pretty much no matter what stock you picked, you were going to be doing well. And obviously, if you were short in March, any stock you pick would have done well, right? But we've reached the point now where it really helped. It really, a lot depends on what stocks you're picking and whether they're going to go up or not, because there's a lot of money rotating back and forth, and not every chart is mimicking what the overall markets are doing. Keep in mind, we have an FOMC statement today. That could have a big impact on where the market is going next. A lot of the rally that we've seen has been due to stimulus, and it'll be interesting to see what the language is that comes out of today's meeting and whether they're going to hint at even more stimulus that's already been hinted at, but they give more concrete information, or if they maybe say they're going to back off it a bit, and that spooks the market. So keep an eye on that. If you're looking to trade aggressively, which I think we're still in a market that you don't want to trade too aggressively, but maybe wait till after 2 o'clock and see what the color of the statement is and see how the market reacts to it, and that'll probably give us a good indication of whether this market wants to continue exploring higher, or whether we're finally starting to put in a ceiling. I still think that we're probably going to trade sideways for the next couple of months, if not down, and I think the market at this point is still just really looking for a ceiling and trying to figure out exactly where equities are too overpriced for people to want to go ahead and get long. And up to now we haven't found it, but we might be starting to see some pressure here. And we're going to go, when we go over these 4 indices now, you'll see that we're starting to hit some pretty important levels of resistance on some of these. And it should be a pretty interesting level of supply, or source of supply, and it might be able to finally sort of eat up some of the demand that continues to be pervasive in this market. Alright, so with the S&P 500 first, we're going to look at the ETF SPY. And as you can see, I have a red line here. We're going to go ahead and extend it. But first I'm going to go to the weekly chart, give you an idea of what that is. So here's that red line, which is basically not a very significant long-term level, but in the short term it was a pretty critical level earlier this year as we really ramped up and took off to new all-time highs. And right before the whole coronavirus thing took off, this was a nice floor for the market. Again, if we go back and we take a look at where we were in 2018, 2019, where we were trading, we started to really take off last year. We had a nice Christmas rally, a nice rally into the end of the year, and the market really exploded upwards. And then as we started to hit these levels around 320 to 330, you can see that the market used 320 as a floor on the ETF SPY and on the S&P 500. And that was really where we started to accelerate to the downside once this market turned around in February and March, right? And so now if we go back and look at it in the daily chart, you get a clear picture of why this red line is significant in the short term. You can see again, like I said, we had the gap down on the first initial the beginning of a panic about the coronavirus, and then we had the real big drop, and then that was the point that we really started to accelerate to the downside. We came up, tried to get back above that area, couldn't even reach it, and then eventually came all the way back down. We finally made it back and have made it to this point, and so this is an important area because again, it's basically demarcating the difference between the market that is post-coronavirus and the market that was pre-coronavirus, right? So if we're trading back above this level, then the market is thinking that basically our economy is, well, not necessarily our economy, but that the stock market is projecting prices to be equal to what we were doing before this whole pandemic began. And again, I feel like that's a little ambitious, but with the amount of stimulus that's been pushed into it, you never know what's going to happen next, right? And so that's where we are, and that's what I consider to be a critical level of supply. If we were able to push past that, the market's going to make its way right back to the level we were before we gapped up and right next to all-time highs. So keep an eye on that. Right now we're printing a bull flag, which is actually bullish. And in order for us to really have a nice pullback, we're going to need to lose not just today's lows, but maybe this candle from Friday, and then maybe come back and fill this gap to the downside, and maybe head back and test the 20 period and the 200 period moving average. Now, here's the thing, though. For those of you that are looking at this market and wondering how strong it is and whether this should be this strong or not this strong, right now, it doesn't matter what our opinion is, whether we think the market deserves to be where it is, whether we think it doesn't, whether we think this is smoke and mirrors. The fact of the matter is that the market is at these levels. And even if we do pull back, I don't think it's indicative of a market top at this point. We've had such a big explosion to the upside. We have such a strong uptrend that at this point, if we do pull back, it should be viewed as a buy the dip opportunity, not necessarily as the top of the range and a reversal and a resumption of the bear trend. I think at this point it's pretty clear that we expect a full recovery from the coronavirus, and unless we start to see drastic news of a second wave that's as bad as the first wave, I think that we have as firmly established where the lows of this market are, and I do not expect us to come anywhere near those levels again. unless, like I said, something really drastic happens and we start to see a strong increase, not just in cases but in deaths. And if not, the market, I think at this point has assumed that we've gone through this and that it's in the rearview mirror, and now it's just a matter of recovering and getting people back to work, and getting a lot of the unemployed employed again. And I think those are going to be some of the bigger points of interest coming soon. And I think those are going to be some of the catalysts for this market to pull back. But I think at this point it's pretty clear that we have reached the point where we're really rallying. And even if I think we're going to be range bound, I think that the next couple of drops are probably going to be bought as the momentum from this continues to kind of persist a bit longer. So if we're expecting a drop, or we're expecting to move back into, the 270s or the 260s, it's not going to come in the first drop unless there's a lot of bad news, which at the moment there isn't any. I think at this point, when we get these drops, we're going to be testing some of these levels, and we're going to come right back up and retest whatever ceiling it is that we form. Now, in the long term, we're talking 3, 4, 5 months down the road. Yeah, maybe we are going to pull back and head a little bit further. Maybe we're going to switch from a straight up trend to a sideways trend. But at this point, we have to just assume the trend is intact. And if we do pull back, we should be buying the dip on these, at least the initial dips, and see where it goes in the next bounce. So that's something critical to keep in mind for those either maybe anxious to short this market, or maybe thinking that this market is way too high from where it's supposed to be. You don't want to fight the price action, and you want to keep your personal opinion out of what the market is doing. I personally also feel like maybe we're a little overextended and a little too high. But the only thing that keeps me from buying right now is risk reward. It's not my opinion. And if I find stocks with good risk reward, like we'll go over in a little while, I'm going to go ahead and play them to the long side because they're still working at this point. So keep that in mind, and keep an eye on that. Now, major levels here. Let's take a look at what levels we can look at if we do pull back or if we do continue upwards, right? So, as you can see, like I said, we're working through a pretty important level in the S&P 500 at 320. If we continue to hold here and eventually move up from this bull flag, we're going to fill this gap in very short order, which is right above it at 326. More likely than not, we're going to come all the way back up to 332 and actually fill the gap. Again, that should be very, very strong resistance, and I don't expect us to push through that level. But if we keep pushing through them, we keep pushing through them, right? Now, to the downside, if we do pull back, you can see we're starting to get pretty extended from the 20-pair moving average. When you have a strong trend upwards, the first pullbacks usually find support at the moving averages, right? So if we come back and test the 20-pair moving average, that should be good support, and that should lead to a subsequent bounce. And I think at that point, that's when we take a look and see if we can come back and push back through those levels of resistance that put us pulled us back in the first place. So that's one of the key things is to watch. If we do pull back, are we going to just tag the 20 and then come right back up and retest 320, or are we going to come back and fall short of it? Now, if we lose the 20 period, if that's not enough to support price, for instance, let's say the FOMC statement says that they're not looking at stimulus anymore at this point. They think that we're in good shape, and the market panics, then we're probably going to come back and test the 200-pair moving average, and possibly a bit below it down here to 295. Now, this 295 area now becomes major support. This was an interesting level, nice little ceiling in the short term in May. And you can see once we've broken out from that, we've just trickled upwards very slowly and steadily upwards, right? So if we come back, that should now be a floor. There's a lot of buyers that came in here, and there's a lot of buyers that missed this move up. I'm sure some of you guys are kind of in the same boat as a lot of other people, which is you weren't trusting the market, and once it broke out, you feel like it left you behind, and you've been patient, which is a good thing, and you've been disciplined, and you haven't chased it upwards, but now you're feeling like you missed out, right? You're not alone. There's a lot of people that feel the same way, and they're waiting for a pullback in order to buy. And these levels we just outlined are some of the same areas that other people are waiting for to buy as well. So that's going to create a lot of demand as we come back and retest some of these areas that we were kind of breaking through in the last month or so. So those are the key areas. I don't expect anything below that. I think we're going to have a lot of bad news before we head back down below 295 to 300. Again, that is a very critical long-term level. Right, this 295 to 300, and in order for us to lose that, I think at this point we've kind of established that we're right back to where we were at the start of the year, and maybe we're not ready to move to new highs, But at this point, the market thinks that it's back to where it was earlier this year and not where it was in the last couple of years. And so that's going to now be an important line, and demarcation again, another battle line between the bulls and the bears, and that's going to be a critical battleground if the bears do want to eventually take over this market, is to push it back below 295 and into that range that we spent 2018 and 2019 in. And again, I don't expect that in one move. I think that for us to get back to that level, it's going to take some repeated pushes from the bears, because the bulls have been so strong, and like I said, there's so many buyers that missed out on this last move and are looking to get in when we eventually have a pullback in price. All right, so that's the S&P 500. That's the SPY. Those are the critical levels that I'm watching. I think, again, we're going to get a much clearer picture after today. FOMC days a lot of times can have an impact on the market, and one piece of advice I could give is with the FOMC statement is, around 2:15 or so when it comes out, you don't want to just blindly or quickly follow the first impulse. There's usually a back and forth. There's usually an impulse in one direction, and then it has a kind of a violent swing back in the other direction, and then eventually it sorts itself out, and towards the close of the day and even into tomorrow's open, we'll get a better idea of what the real reaction is going to be to the FOMC statement. And at that point, we'll get a clear picture of where the market wants to go next, whether it wants to keep pushing upwards into these January and February levels, or whether it wants to finally pull back and start testing some of these levels that we've just kind of been going through. And I think most people are hoping for a pullback, but because most people are hoping for a pullback, that the market might, it tends to do the opposite of what people are expecting. So it might, in that case, just continue to push upwards. So don't be surprised if that happens. I personally think that we should pull back, but like I said, it's not up to me. The market likes to surprise people, and it likes to do its own thing. And if there's not enough supply yet, if there's still people that are willing to chase this, then it's going to continue going upwards. All right, now here's the interesting one, right? So if you look at the Qs, just blasting off new highs, continues going upwards. Now you'll notice momentum is dying down, right? Notice the candles are getting smaller as we go up. Volume is decreasing as we go up. So I think we're getting close to an end of this particular little short-term jump. Very strong. Now the interesting thing is, at this point, it's cleared the highs by enough that when we do get a pullback, it has room to pull back and still test the highs and still establish that we're in breakout mode. Fat Boys, you asked me yesterday, why are the Qs doing so well and why is the Dow Jones doing poorly? And there's a couple of reasons for that. One was what I already mentioned, right? That money is rotating back out. Over the last couple of weeks, really, or really over the last week or so, a week and a half, there was a rotation in money where a lot of the beaten up areas that hadn't fully recovered or are still trying to recover gained a lot of momentum, and a lot of those were in the Dow and IWM. A lot of industrial names, or a lot of smaller cap names, retail stores and stuff of that nature. And at this point, we've kind of had a kind of a resumption of the uptrend with the tech names. If you look at, keep in mind, the Qs are actually heavily weighted towards the FANG stocks and some of the heavier, some of the bigger tech names, right? So if you look at stuff like Amazon, right? Look at Apple. Look at Google. Look at Facebook, right? Even if we look at Microsoft, these are the names that carry the Qs, right? And so most of them are doing well. Most of them have finally started to pick up and blast off, because a lot of those names were insulated from what was going on in with the coronavirus shutdown, and so they're taking off. They've reached the point where they've begun to realize that their business hasn't slowed down at all, and the Qs is so heavily weighted in them that it's going to follow suit. Now, it is what it is at this point. I don't think it makes any sense to argue with it. Clearly, the Qs want to continue upwards, and at this point now, it's a matter of what happens when we do pull back. You can see again, we're starting to get a rising wedge up here. This is not a good time to chase the action. I think a lot of those tech names have already kind of gone upwards, and at this point, people should be taking profits. or waiting for a pullback, right? So the question now becomes, when we pull back, when we've got new, let's just put a line here. This is the all-time highs from earlier this year. So we're going to make a new level here. We're going to make it green, right? Because it's... So as long as we're above this, we're in new territory, right? So that's the question now. When we pull back, are we going to hold above the last all-time highs? Are we going to establish that the Qs and tech names are in a better place now than they were in February and January? And if they are, then the Qs are going to continue going upwards. If they're not, then we're going to eventually kind of roll right back through that level and come back and test some prior levels. Now, the key levels on the NASDAQ are a little bit easier to judge, right? Upwards, there's no level of resistance, right? Everything's theoretical. There's no supply waiting. There's no one that's underwater waiting. Anybody that bought the Qs at any point other than the last 10 minutes or so is in the money, right? And whether you bought it yesterday, whether you bought it a year ago, whether you bought it 10 years ago, you're in the money. The only people that are down are people that bought it, earlier today. And even then, they're basically break even, right? So there's no real potential level of resistance at this moment, right? If we do pull back, clearly 237, 238, that should act as a floor. If we fall a little bit below that, I think the 20-period moving average, like I said before, when you have a strong a stock and a strong uptrend, the 20-period is going to support it on the initial pullback because it's just the momentum persisting upwards, right? And it's going to take a slowing down of momentum before we start to have an erosion of price action that leads to a move through the 20-period moving average. Then, so unless there's strong news that kind of dictates a move through it, we should expect support to come either in 238, 237. Or if it kind of falls below that into the 20-period, wherever the 20-period is at that point when it comes to meet up with price. Now below that, let's say again the market reacts very poorly to whatever today's FOMC statement is, and we get some big red candles. Well, there's major support for the Qs up here around this 223 down to about 218. You can see again that red line that we were judging on the S&P 500. This is where the S&P 500 is stuck right now, relatively speaking. But for the NASDAQ, it's well above that at this point. And if we do pull back, we're going to retest those levels again. And you can see again, last time we came back and tested that level, we had this really strong hammer. And that should be a strong level of support. And if we fail that, anything down here below 220, I don't really expect us to push through. Again, with the strength that we're seeing in this market, we probably don't lose the mid 230s, and if we do lose the 230s, we likely will find very strong support in the mid 220s. Again, this is the strongest area of the market, and even if the market does roll over and does find a ceiling, this is going to be the area that behaves the best and is going to hold up the best in the near future. So I think, again, if you're looking to play to the long side, tech names, again, are pretty much the place to be until we see a real big change in character. Especially, it's the safest names to trade right now. There's been a lot of momentum in some of the smaller cap or some of the more beat-up names, but they also have more risk involved. And I think that if you're looking for names that have less risk involved, now there's always risk, of course, but I think at the moment these tech names have less risk because, again, they're pretty well insulated to a lot of the impact that we have news-based from the coronavirus right now. And so, they're able to perform well, even if people say that we're going to have to continue slow back down and get back into shutting down businesses. A lot of these names are still going to perform well, and so they're kind of more insulated than maybe, say, the airlines. If for whatever reason there's a resurgence in infections and they have to shut down the airlines again, those stocks are going to get hammered hard. But something like Amazon is still going to be fine. It's going to even thrive probably. All right. Now, here's the Dow Jones. Sort of like the S&P 500, right? We've got a nice little bull flag, 2 or 3 days down. Now, again, it doesn't look bearish despite the fact that we are seeing some selling pressure at the moment. We're going to have to see a bigger reversal before we can expect any kind of a bearish trend. We're below the red line, relatively speaking. Again, if we go back and look at the weekly chart on the Dow, you can see where it stands and where this the January, February levels are, and where we are next to them. So the Dow Jones has been relatively speaking weaker, and this makes sense. It has certain names in it that maybe have struggled a bit because there's been a slowdown in our economy, and it gained a lot of strength recently when with hopes that we're going to open right back up and get back to work. So you started to see a resumption in the Dow trend, in the Dow come kind of trending upwards. And again, it's slowing down today, and I think a lot of that is probably due to profit taking. You're not going to have those names rally forever, and I think they hit a lot of them hit walls of resistance that were pretty important, and they started to find some profit taking, a little bit of a sell-off, and that's what we're seeing in the Dow Jones. Now, overall, if you just look at the indexes as a whole, it's still not bad. We just got a little hammer candle here. We have basically a little bull flag. So at the moment, this is still a bullish continuation pattern, and we're going to need to see more selling pressure before we can say that this uptrend is done. Now, one thing to keep in mind is we have a nice little trend coming here, and it's starting to lose a little bit of the momentum. So, maybe we pull back a bit from here. But I think again, it's going to be down to whatever the FOMC statement says. Now, one critical thing to note is last Friday and then Monday, Tuesday, Wednesday of this week, we were able to kind of eclipse this important talking point that we had last week, right? Which was when we had this first drop in the this sort of first COVID-19 induced drop. We had this pennant, right? We had a bounce, an attempt at a bounce, came back up, and ultimately failed here at these 270 levels, and then really accelerated to the downside. We've kind of overcome that. So, we continue to overcome some of these important benchmarks of resistance that have been kind of weighing down and kind of supplying, or putting extra supply in the market. And so we were able to overcome a pretty important level. So even though we haven't come back and reached this critical 284, we're slowly making up ground, and we're slowly catching up, even in the Dow Jones. And so right back above that level, which again is important, and offers support once we do pull back. So now when we pull back, we have a new level that we can watch. We have this gap that was created last week, the 200 period moving average. Again, just like the other indices, the 20 period now is moving steadily rising upwards. All of these should act as support once we do pull back, and should offer people a nice buy the dip opportunity once it gets back to that level. Now, the real critical level, if we do have a strong move to the downside, on the Dow right now, I think 247 to 250 is pretty important. Now, if we look at the weekly again, you can see 265 is also a very important level. That's the ceiling from the price action from 2018 and 2019. And that should be an important price point, but we're pretty close to that. And so if we lose that level, if we have strong selling, the Dow Jones is not going to hold at that level. While I expect maybe the S&P 500 and the NASDAQ to trade above those 2018 and 2019 levels, the Dow Jones has been hit harder during this whole coronavirus situation. And so if we do have a strong pullback, I don't expect that level to hold for the Dow like it did for the other two. I think that it could hold in a short-term pullback, but in a more impressive move to the downside, then it'll probably lose that and come back and test maybe the 250 area. And then we'll see where it goes from there. Other than that, I think everything I said about the S&P 500 kind of stands for the Dow. The last index we want to look at is IWM. And the small caps, again, like the Dow, the small caps have performed really well over the course of the last maybe week and a half, maybe 2 weeks. And you can see losing a lot of pressure today, or a lot of ground. Strongest move to the downside, almost 2%. We don't have a bull flag on IWM. Instead, we have kind of a drop down back to its 200 period moving average. The Dow has been the weakest, and it's going to continue to. The small caps are going to continue to be the weakest. The Russell 2000, and you can see, unlike the Dow, we didn't actually overcome this pennant from back in March. We kind of came up, we tested it, and then we failed. So, relatively speaking, still the weakest of the four indices. Couldn't make our way back up to the January, February levels, and couldn't even make it up to there. And that's what's even more impressive, is that those January, February levels, they weren't even all-time highs, right? So overall, IWM is still by far the weakest of the four major indices, and still struggling to play catch-up. Now, it was nice that we were able to kind of really respond to a potential breakdown back in May and play. And they've made up a lot of ground and they caught up a lot, but there's still a lot of room to go before we could consider IWM in the same neighborhood as the Nasdaq or the S&P 500 or to a certain extent even the Dow Jones. And so we'll see what happens here. I think again this shows that traders are, while they were beginning to accept more risk recently, it shows that again they're taking profits pretty quickly and moving out of these names as soon as they hit their targets, rather than kind of holding up for hoping for longer term moves. And so we'll see what happens here. Now, if we do get a pullback in the market, this is going to be the area that moves the quickest. I would expect to move right back to the 20 and probably below it, back to this level around 136. I think this is a pretty important area, and if we can hold above that level, I think it still bodes well for a potential bounce in the markets once we do correct. And if we lose that level, there's a lot of room to the downside. I think the 50-period moving average would probably be where we get to. But again, I would expect initially when we do pull back that we find buyers and we bounce even on IWM. There's been a lot of bullishness that's kind of come back into this market, whether it's because of stimulus or not, and even the small caps have benefited from it. And we've had there's been some very explosive moves in some small cap names recently, and you can tell that traders are getting more aggressive, and money is willing to flow into these names. Now it will go out as quickly as it came in, but we are seeing some pretty big moves. And again, we'll go over a couple of some names that I think that are good examples of traders willing to accept risk and some of these explosive moves we're seeing once we get into the chart request part of today's stream. All right, so those are the four major markets. My overall thoughts are very similar to what they've been for the last couple of weeks, which is this market is very strong and continues to probe upwards, looking for a ceiling. But I think it's getting very close to that ceiling. I think for the most part we are at a good turning point in the markets, and depending on what happens with FOMC, we might be able to finally see the market pull back and establish a ceiling for price action in the short term. Now, interestingly enough, for the Qs, there is no ceiling at this point, and it'll be interesting to see. I think there's going to be a nice dichotomy here in this market. Once we do pull back and we start to bounce, do the Qs continue to rally while the rest of the indices kind of stay stuck trading sideways? Or will they follow suit and try to rally with the Qs? And I think that's going to be an important question that needs to be answered in the next couple of months. But I think right now, where we are, I think that we're getting pretty close to a ceiling where the market should switch back to neutral and start trading sideways. But until it happens, I'm going to keep taking my shots. Like I said, it's a stock picker's market, and I think that there are plenty of stocks in both directions right now that we could probably trade. All right, let's take a quick look at the U.S. dollar. I'm not going to spend a lot of time with it today, but as you can see, the U.S. dollar continues to lose ground. Expect some sort of impact with FOMC, the FOMC statement today, and that may give it a little bit of room to kind of bounce back up. But as you can see, it's lost a lot of ground recently. Continues to drop. This was something we noticed last week, and the momentum continues to push downwards. It's heading into some good support, and it's likely due for a reactionary bounce very soon. If we look at the Euro-US dollar cross, you can see the Euro continues to rally versus the US dollar, and at the moment it's consolidating, but it's still trying to climb upwards. Again, showing a lot of lost ground by the US dollar. At this point, again, I think the US dollar probably needs a little bit of a snapback. I think the Euro is probably going to get a little tired out, and we should see a little bit of a move back. But until we see a full reversal, we just have to respect the strength in the Euro right now. If we look at the U.S. versus the Canadian, again, you can see the U.S. dollar lost a lot of ground versus the Canadian. And a lot of this is due to oil, which we'll look at in a second. Oil continues to gain strength and rise in price. I think oil is getting very close to what I would consider to be a pretty critical price as well. And that should lead to a bounce in the U.S. dollar versus the Canadian. So interesting. Even though the U.S. dollar has been pretty weak, I think that there's probably hope for a short-term bounce in the very near future. And if you're a forex trader, you might want to start looking at seeing if a reversal pattern could be fully completed in some of these areas. Now, the last cross we like to look at is the U.S. yen. And in this case, the U.S. dollar has held up a little bit better because Japan started doing its own stimulus program. However, even over the last 3 days, despite the yen weakening, the U.S. dollar has lost ground versus that as well. Now it's back to support, and it'll be interesting to see whether it can hold support here and bounce. But generally speaking, I think if you look at the U.S. dollar and all its crosses, you can see that it's lost a lot of ground recently, but it is heading into potential areas of support and is maybe due for a bounce. But we'll see what happens. Again, FOMC statements have a strong impact, obviously, on currencies, and so we'll see what happens with them. All right, so let's look at oil first, and then we'll move on to gold. Since Fat Boys, one of your chart requests is gold futures, we'll look at gold futures in a second. Now, unfortunately, for this chart is going to be a mess for a while. We're going to need another couple months before we can get this big candle in the rearview mirror. So again, I think it's easier to look at this as a 4-hour chart. All right, so here's what happened with oil since it went to negative prices, right? And as you can see, we had a lot of volatility the month after, or at least the next couple of weeks after, but since then, it's trended straight up. Again, pricing in what it considers to be a strong recovery in our economy, right? Because it's expecting stronger energy consumption, and it just keeps going up, right? Now, we've reached the point, I think $40 is a pretty strong area. That's a long term, that's a pretty important area, even if it's going to be hard for us to watch in our chart right now. And it'll be interesting to see whether we could push past 40 and start making our way back into the mid-40s. If not, I think that this might be a spot where we lose some momentum and finally get a stronger pullback on oil. Now, at this point, there's plenty of room to the downside where the oil trend could still kind of remain intact, or at the very least remain in kind of a healthy state. So it might be a spot here where we start to see it lose ground. Now, if it does lose ground, again, I think the U.S. versus the Canadian should start to make up some. That might be one of the areas how the U.S. dollar makes up ground versus the Canadian. But keep an eye on this. There's been a lot of movement in oil names, with oil continuing to gain some strength, and some of them have been moving kind of explosively. And it'll be interesting to see whether that can persist, or what ends up happening once oil does pull back. Are these oil names going to start to pull back with it, or have they reached the point where they're a little bit safer state? Now, let's look real quick at gold. So here's GLD. Now, Fat Boys, you're talking about gold futures as well, but I think we're just going to look at GLD if we want, because gold futures is basically the same chart, but I have most of my I have all my trend lines on GLD, so we're going to look at GLD, but it's the same thing. GLD tracks gold pretty well. All right, so last week we mentioned that it was coming into support and it was probably due for a bounce, and we've seen that. It's bounced over the last 2 or 3 days. It's still range bound. Bigger picture, this is all GLD is really doing, right? It's just trading between 158 and 165 or so, and that's really all it's doing, and it's in the middle of that range. So, at this point, is it a good trade? Not really. You've got just as much potential to the top of the range as to the bottom of the range. It's right smack in the middle. Now, if you're long gold, what do you do here? You probably wait. You want it to come. It bounced off the bottom of the range, and your hope is that it makes its way back to the top of the range. Depending on what kind of a trade you took, maybe you want to scale half out. If your expectation was just to move back to the top of the range, then maybe this is just where you decide, well, I'm going to take half here and then the other half at the top of the range. I'm not really sure if you're in a trade or if you're just looking at it, but this is what I'm looking at now. Again, I didn't actually trade gold. I've been finding other names that I've kind of been more enticed to trade rather than gold and silver. I might have missed some opportunities on gold and silver, but they're not in the areas that I feel comfortable at the moment. And like I said a couple of weeks ago, I mentioned this. This market is not really the easiest market to trade right now, right? If you look back, this is an important point to bring up for those of you guys that maybe haven't heard this yet. There are good times and there are bad times in the market, right? If we look at, this is a monthly chart. of the S&P 500. We're going to go all the way back, and so we're going to start with 2007, 2008, right? So, this is not a good time to trade the market, right? I guess we'll use the rectangle tool again. This is a hard time to trade. I'm not saying you can't trade, because there's a lot of money to be made during this kind of volatility if you're a short-term trader, but it's not an easy time to trade. Now, when the market transitions, it's also very difficult to trade. Right? Because at that point, you don't know whether it's going to continue a downtrend or whether it's going to turn into an uptrend. However, once you do get a nice uptrend, this is when it's easy to trade, particularly during this stage here, right? 2012, 2013, 2014. This is a very easy time to trade. Basically, any mistakes you make are usually erased by the market. There's no real strong volatility. There's no real strong pullbacks. So that's when you want to really push the envelope and you want to be really aggressive to the long side, because the market is rewarding you for that. And then, as it always happens, eventually you switch gears, and then you get into a sideways market that's trying to roll over, right? Now, that's not an easy time to trade. There's a lot of back and forth. There's a lot of volatility. If you're a range-bound trader, you could probably make good profit here, but it's not as easy a time to trade as what it was before, right? And then what happens again? Eventually, you have a strong rally, and again, that's a very easy time to trade. The market is just going straight up. There's no strong pullbacks, and then you get back into what we are now. It's not an easy market to trade. And a matter of fact, it's gotten even more difficult to trade as we moved into this year because of the increased volatility in both directions, right? So during these times when the market's really difficult to trade, you want to be more cautious and you want to be very careful about how you trade, because you don't want to push the envelope and you don't want to get too aggressive, because we're in a market that punishes mistakes, not one that erases mistakes. So, gold and silver, they might present opportunities, and some traders are comfortable with them. But at the moment, I found other stocks that I feel more comfortable with, or more equities I feel more comfortable with. So I've kind of stayed away from these. But generally speaking, at the moment, I mean, gold, I don't think it's a difficult chart to read. I think it was a good support buy last week, or on Monday of this week and Friday of last week. And I think at this point, it's making its way back to the top of the range. I'm not saying it's a bad trade. It's just not one that I've taken. And silver's kind of doing the same thing, but on a different pattern. It was very weak compared to GLD, and it's finally playing some catch up, which I think again was showing signs of a market that expects a full recovery, because there's more industrial applications to silver. But it's the same as gold in that it found support, and it's in the middle of the range now between the top of its short-term range and the bottom of its short-term range. So it's kind of right smack in the middle, and not in the best place to trade today. It wasn't a good trade, it was a good place before, but if it's a long-term holding for you, I would say just keep holding it long-term. You're in nicely. If you're in at 140, you're up pretty nicely, and I think it's still trending upwards. I don't think it's trending down. I think if we look at GLD on a monthly chart, and you see what it's doing, it bottomed out in the 118s. We're really all the way down to 102, 101, but it had a very nice change here. We had a downtrend, then we had it graduate to neutral, and now it's an uptrend. The trend is up. Whether it pulls back or not, even if it goes back down to 140, I think the trend is upwards right now. And if it's a long-term holding, then you're just going to hold it. I don't know what your ultimate goal is from it, but at the moment it's doing fine, and it's up nicely. There's more room to go before it hits major levels of resistance and all-time highs. And so, you just let it do its thing, right? You don't want to overthink these long-term plays. All right, now let's look at STNG. That's a tanker. So, kind of switching gears back to oil. Now, these tankers, they did really well when we had the whole issue with oil demand, right? And I'm a little surprised at how quickly they've come back. I would have expected them to profit with the amount of oil that they were holding, and with prices going up. I would have figured that unloading that oil would have been good for them, and that it would have increased to their profits. But in reality, their stocks haven't done well. They've actually done poorly, and have almost been kind of inversely correlated to what the prices in oil have been. You and I discussed this privately a little bit a couple of weeks ago, and how I wasn't that excited about these oil tankers because I didn't like the behavior that they were doing. And so I'm going to show you on this chart basically what I didn't like about them and what I still don't really like about them. So we have this. This is a very nice, kind of like an inverse head and shoulders, right? We had a move down to about 1540, up, then down below it, then back right around that area, and then up, right? So this is a nice bottoming pattern. We had the big move upwards, and then we kind of came back, retested it. Now from there, typically when you have this kind of reversal, this kind of bottoming formation, when you come back and retest it, you're supposed to rally off of it and come back up. But what happened here? We failed. We came right back in, and we're right back in this range, right? And we're losing ground. We're not actually gaining ground. We're losing ground, right? So even here in this attempt to bounce back, we're not getting back to this 2030, 2040. It's going backwards, right? So it came up, tried to get through, came back, fell short, came up, fell even more short, right? So at this point, if you want to go long a name like this, it has to do something that tells you it wants to bounce. It's at this point, it's not really. I mean, yeah, okay, it's establishing 16 as a decent floor, so it's showing that it doesn't want to come back into 13, but it hasn't actually done anything positive really to get back above the $20 range and maybe back to what it was before. So, you know, I'm not excited about this right now. Now, can it bounce here? Yeah. Would I want to buy right now? No. I think if anything, if you really want to play this, maybe wait for it to change and start making its way back up to 20, right? So maybe it comes back and trades another couple of times between 16 and 17, and then eventually breaks this short-term downtrend and starts to climb upwards. Then you can maybe anticipate a move back through 20, and you can look at it from that perspective. But I think for now, you know, I think it's below some pretty important areas, right? If it was going to bottom out, it would have bottomed out and it would have started rallying, and it's not doing that at all. It's actually coming right back and kind of holding below these price points. So this is one that if I wanted to trade it to the long side, I would want to see something different. I want to see, you know, the bulls take control of this. I don't think the bulls are in control right now. And at the very least, I'd want to see that. I'd want to see some kind of change where it can actually start to break through some of these levels that are above it, rather than just kind of losing ground and just kind of churning neutrally. You know, if you look at it, even the volume patterns don't really suggest that it's ready to bounce. It's huge volume during the whole oil thing, and then the oil collapse, and then it's kind of, volume's still elevated compared to what it normally trades, but it's still kind of, it's not really showing signs of strong accumulation yet. I think it's still showing signs of unwinding, and a lot of people jumped into this thinking it was going to do well, and it didn't. And so I think at this point it's kind of just struggling to unwind a little bit more. There's still a lot of people that bought this that are still down on it, and I think that's why every time you get a bounce, it gets hit down really quick, is because people are trying to get out at break even or a little bit low, just kind of cutting their losses. And so I think we're going to need to see a bigger shift in character in this before I'd want to get involved in it. Okay, so that's basically longer words of what I told you last, a couple weeks ago, on why I just don't think the price action on this is that great. It could eventually gain momentum, and when it does, it could have some big moves to the upside. But at the moment, it's not really doing anything that I would consider to be positive. And again, if we go back and kind of rehash the discussion we just had, in a market like this, there are safer trades, and there are trades that I think are easier to take. So why would I want to gamble on a name like this that's not really, it doesn't check off any of the boxes I'm looking for right now, as far as names that I want to trade to the long side. Okay. Now the other one we want to look at, you asked about Avis. Now we discussed Avis last week or the week before, I'm not sure when. I discussed this with you somewhere, and it had a big move. Now this is I think a good example of some of the names that are starting to get hit this week, which are the names, the last couple of weeks, especially last week. A lot of the names that did really well are the ones that were doing very poorly during the whole coronavirus shutdown. airlines, retail stores, food like restaurants. Those are some of the areas that really did well. And for those of you that are Patreon members, we did very well with some of those trades, right? And Avis is one of those types of trades, right? So for those that maybe don't know, last week, this is one of the names we were looking at. And actually, this is one of the points I wanted to talk to you about was this trade on FRAN, right? So we had a trade on Francesca's holdings, right? And it went from about $3 all the way up to the mid fives. So huge, strong move, right? We had another one at McDonald's that worked out really well. So FRAN, by the way, FRAN is a retail store. McDonald's, obviously, fast food restaurant. And again, big move from 188 all the way to the 200s, right? And if you look at stuff like, airlines. No, we didn't trade the airlines, but again, last week, big moves, and a lot of these names that have been shut down and have been been struggling to kind of regain some business, right? And now we're seeing a pullback in them. By the way, these are some of the names that we're looking at shorting at the start of the week, and they've given us some nice shorts. But so your question is with Avis, is it worth a buy right now at the 200? Whoops, that's not car. That's not car. Let's look at car again. All right. Okay, so you're asking, is it a long now at the 200? So, this is an interesting question. This is actually a very interesting thing to decide right now. Is what do we want to do with names like this, right? Because this, I think, going long this, your decision dictates a lot of what your thoughts on the market right now. If you think the market is going to continue going upwards, then you want to start looking at buying these names because, again, these names are rallying strongly because the market is pricing in a recovery. And if you think that recovery is priced in and you think we're going to continue to recover, then you think that these names are going to continue rallying. Now, the question becomes, is this worth a long at 200? It could be. It could very well be. You can see we're printing a hammer today. Would I go long off of today's candle? No, not yet. We're only beginning to see some selling pressure now. And there's a chance that this thing needs to come back all the way back to 19 or 20, back to the 20-pair moving average or down back to this price before it bounces. So at the moment, I would not buy it yet. Now, does that mean that a long at the 200 moving average won't work? No, it could. But what I'd like to see is maybe another hammer candle tomorrow and then a green candle. And then at that point, it would show that there's a lot of buyers that have stepped up and supported it here. I think at the moment, this one candle is not enough proof to me, particularly because my thoughts are that the market is now starting to reach a ceiling where it wants to roll over. And if it does roll over, I think names like this are going to be the first ones to keep going down. So I don't want to say it's a bad idea to trade this to the long side. I think there is definitely a situation that could arise where these names could continue to rally strongly. But I'd want to see more clarity out of this before I went long. Okay. I think we'd wait to see what happens with FOMC today. Maybe see how we open tomorrow. And I think at that point we might get a better idea of the nature of the price action and whether we're going to bounce and keep pushing upwards or whether we need to pull back and test a little bit more deeply. And so that's what I'd be waiting for here. This initial pullback is decent. It's only 3 candles and we're finding buyers. But I'd still want at least one more candle, maybe 2, to tell me that we're not going to break through the 200 and head back down. Oftentimes this does hold, and if we look at it on the weekly chart, and we look at the longer term price points, we get a decent idea of where we are right now. And you can see basically, real support is down here around 2150. Where we are right now is kind of in the middle of a lot of price action. Let's maybe look a little farther back, right? So now here, these are kind of the 2 major price points. So if you look at Avis, right? From 2016 to 2020, it's basically been a stock that fluctuates between 39 and about 22, right? It's gone up a little bit above it, maybe a little bit below it, but it's been basically a stock trading in between those prices, right? And at this point, it's kind of right back in the middle around 27. So, um, it's right in the middle of that range, and it has a chance of making its way back up to 39. So I'm not going to say it can't be a good buy there, um, but 22 is a much better buy if it does get back to that price. Okay. Um, all right. So, anyone else have a chart request? I'm going to point out a couple of things that I looked at this week. So, here's one of the stocks that I wrote on Monday. For those of you that are my Patreon subscribers, I'm hoping you guys are long this and are doing well on it. It blasted. So here's, despite the fact that I think this market has reached the point where it's pretty overbought, and I don't like the risk reward in the overall market, there are still names that are giving us good risk reward, right? And so here's a name that I feel gave us very good risk reward and was worth taking a play, right? You can see it was in a nice pennant. It was actually broke out the last couple of days. It was able to break above the bottom of this descending trend line, this little triangle. And today we had the huge explosion on huge volume. We're able to push right through all of our initial targets. And at this point, basically have a trade that we can't lose on. We've already scaled out and have kind of reached our final target, but I'm going to give it another day or two to see if it could push past it. But I've already scaled out a good amount because it's given me exactly what I want. However, I'm still holding a bit because I think that the momentum could push it higher, right? And so this is the kind of name that I think illustrates the fact that there's still good risk reward in this market. This is very similar to the name that we had last week, FRAN, which provided very good risk reward despite the fact that we're in a market that maybe wasn't as conducive to long plays as we would like. Now, I do want to discuss this a little bit with you fat boys because this was one of those trades where I thought that there was a lot of room to the upside. For those of you that were here last Wednesday, we discussed the potential for a move to $5 on this, right? That we were looking at it. Initial target would have been right around 350, 360. Then we had another target in the fours, like maybe 420, 430. And then we had finally a move looking to get back into this area around 520. And so this is why you want to scale out of these trades, because you want to go ahead and take advantage of the upwards momentum. You don't want to just close your trade at 360. This might feel like a good trade when you're here, right? You're like, well, I got profit. It's a good trade. I made money, right? But the truth of the matter is that you missed double your profits, if not triple, by holding it a bit longer. It was only 2 extra days. There was really never any selling pressure, and so this is why I like to put extra targets on here instead of saying, well, I'm only looking for one price. I like to scale out little by little as we move up on a stock, because it lets you hold for a little bit longer in case you can get bigger moves to the upside. Now, ultimately, I did want to get rid of it quickly. I didn't want to hold it for too long because, again, I expected selling pressure to come back into these retail names. But you want to make sure that you take advantage of these explosive moves when you get them. And not just kind of rely on the fact that you say, well, it's a good trade. I made money. I'm fine. I'm happy with it. You don't ever want to be complacent like that, because the difference between 370 and 560, $2 is huge on a stock that, it's basically, it erases your next 2 losses instead of your next 1 loss, or your next 3 losses, right? So, not saying don't scale out as you hit these levels, because I can see people getting nervous as it kind of gets stuck for 2 days at this 370 level. But there was really no selling pressure. We never really came back and threatened our stop losses. So there was no reason to not hold this longer and to look for a little bit of a bigger move. Same thing with McDonald's. For any trader, that first day that it had that doji around 192, if you would have closed this out, you would have missed on another 10 points. Which makes a big difference again when you're looking at a stock like this. If you're risking about 4 or 5 points, and then once you get up and you make your initial 4 or 5 points back, but you can actually double or triple that if you hold it a little bit longer. And you have to have a plan in place, and you want to make sure that you follow that plan. You don't want to just kind of, as soon as you see green, you take it because you're happy. You want to make sure that you outline what your profit targets are on a trade and follow through on them, rather than just closing them out quickly. Um, so keep that in mind. That's an important it's an important thing to add to your trading, is to make sure that you're not just exiting right away. That you're actually trying to, and again, I'm not saying the trail of stop and hold this for 2 months. I'm saying make sure that you try to get as much as you can. I mean, again, this is a 4-day move before we hit our max profit. It's not that far. It's not like it's not like we held this for 6 weeks. We were holding this for 3 or 4 days, um, and then you close it, right? And I think that's one of the things we want to keep in mind. A lot of these stocks, like, so for instance, this one, a lot of traders will just close it today. They're like, well, wow, I'm done. I'm happy with this. But there's a decent chance that this thing explodes tomorrow. So we want to at least hold it for another day or two. Now, yeah, take some profits today, but I mean, heck, it's moved up just since we've been talking, right? Since we've been talking, it went up from 995 to 1020. So, you want to take advantage of it, and you want to make sure that you get as much momentum as you can out of these stocks. Because you never know when you have stuff like this. And again, I wanted to show again before we finish or wrap up today's session. I wanted to point out some of these names that have had really explosive moves, showing that there's been a lot of aggressive rallies recently in names, showing that traders are trying to accept or take risks. You take a look at Nikola here. You see the explosion it's had, and it's been going back and forth. There's a lot of room here to day trade, but there's been money flowing into stuff like this. You look at Chesapeake, which is another name we looked at as a possible day trading vehicle on Monday, and you see the wild fluctuation in price here. Going all the way up to 68, then gapping all the way down to 20, going all the way back up to 33, 34, and then all the way back down. There's a lot of movement going on in a lot of different names, and that's an oil name. This is another oil name. Now, these names are names that I think are facing bankruptcy. There's a lot of fluctuation as people try to get in or out, thinking it's going to happen or it's not going to happen. But and again, this is a penny name, right? It's in the 70 cents, but from 70 cents to 40 cents, it was trading at 15 cents just a few days before that. There's a lot of explosive movement right now in certain names, showing that traders are starting to take risks. And again, that just kind of reflected on what we saw with IWM, and particularly with oil names, and where we are, where things are moving and where things can go from here. So, keep an eye on keep an eye out, because there are names that are moving. There are potential trading opportunities for those of you that are willing to explore and look around and dig deeper and try to figure out where you want to go ahead and try to take advantage of it. So that kind of covers it for today. Anyone in here, if you wanted to ask me a question and you didn't, whether you don't know how to work the chat tab on Twitch, or you didn't want to ask in public, you can always just message me on Twitter. If you want me to DM it, I could just DM you my chart and my thoughts on it. You could ask us on Discord. I'd be more than willing to answer any questions you guys have, and give you any help that I can. Again, if you like what you saw here, you can always visit me at patreon.com/stockdarts. And take a look at some of our trade ideas. Some of them are under subscription, but I usually make them free after a week or so, just so that people, at that point, they're not actionable trades, but you can at least still see what I'm giving my traders. I'm not trying to hide everything behind a paywall. You can still at least see what my thoughts were and what I was trying to analyze. Okay, so let me type it in just in case. So if you guys want to visit and see more stuff on more of my trade ideas. Again, it's all archived, so you can go back. There's quite a lot of content over the last year or so. So there's a lot there for you to dig in and see if you like. If you like what you see, you can always visit. You can always subscribe, and if not, whatever. We do these things free every Wednesday on Twitch, and I do put free content on there as well. So other than that, hope you guys have a good rest of this week, and we'll meet again next Wednesday.